Conventional wisdom says the investment with the highest return wins, but two investments earning an identical return can leave very different amounts in your pocket. And the difference often comes down to something many investors overlook: how each one is taxed. What you earn isn't necessarily what you keep, and taxes are frequently the reason. Dividends, interest, and capital gains can each be taxed differently, and the structure of your accounts and the investments you hold may either reduce or increase your tax bill. So let's consider dividends first. Qualified dividends may receive preferred tax treatment, typically taxed at lower rates, 0, 15, or 20%, depending on your taxable income, when certain IRS requirements are met. Non-qualified or ordinary dividends, think bond funds, money market funds, and REITs, are taxed at your regular income rate, which could be higher. So why does all this matter? Two investments might pay the same dividend, but depending on classification, could leave more or less after taxes. And for someone in a higher tax bracket, that can add up over time. Next, interest income. Interest from savings accounts, CDs, or corporate bonds is usually taxed at ordinary income, but there are exceptions. Municipal bond interest is one often exempt from federal tax and sometimes state tax too, while U.S. Treasury interest is subject to federal tax, but generally exempt from state and local taxes. For high-income earners and investors, municipal bonds may deliver a higher after-tax return than corporate bonds, even when the headline rate is lower. Now, capital gains. When you sell an investment for a profit, how long you held it matters. Held more than a year, you typically pay a lower long-term rate. Held a year or less, it's generally taxed at your regular income rate. As an illustration, in the 24% bracket, a $3,000 stock gain might cost roughly $450 at 15% long-term rate versus about $720 short-term. That gap is one reason long-term investing is often more tax efficient. A few strategies are worth knowing. Tax loss harvesting lets you sell losing investments to offset gains elsewhere, and you may be able to deduct a limited amount of net losses against ordinary income each year. But watch the wash sale rule. Sell a security at a loss and rebuy that same security, usually within a 30-day window, and the IRS may disallow that loss and add it to new shares cost basis instead. Some accounts also offer notable tax advantages, Roth IRAs being one. They're funded with after-tax dollars, and qualified withdrawals may not be subject to federal income tax when requirements are met. HSA, triple tax-free. Deductible contributions, tax-free growth, and qualified medical withdrawals may often be tax-free as well. Cash value life insurance may grow tax-deferred under certain circumstances. Each carries specific rules and eligible requirements, so the benefits may depend on your situation. Taxes can meaningfully affect your net returns. With thoughtful planning, asset placement, longer holding periods, and tax loss harvesting, you may be able to keep more of what you earn. Tax rules change, so it's wise to check with a financial or tax professional who can tailor strategies to your situation. Thanks for watching, and here's to more informed tax-aware investing.